Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Amidst the host of data coming at us and markets interpreting whether the Fed, ECB, or BOE will be hawkish or dovish in their actions, China truly seems to be in the world of their own. The property sector troubles has led to China extending support policies for cash-strapped developers, including allowing postponement of loan repayment by a year. On the domestic front, net direct tax collection grew 16% this fiscal year compared to the same period last year. Good morning, JK. A lot of updates coming this week, including US CPI, PPI, a lot of rate decisions by some central banks, as well as Fed speeches. While updates on stimulus measures from China continues to roll in, how are you reading the markets right now?
Good morning, Swaraj. Yeah, speaking of China, yeah, of course, I think their domestic debt situation is very bad, and that's the reason why they have actually made some relaxation for borrowers. But if you look at the data from China yesterday on the inflation, the producer prices fell at their fastest pace in over 7 years in June, while consumer prices are treated on the edge of deflation. So it's a clear case of weakening demand in the country, and that is not good for the economy and adds to the case for policymakers to use more stimulus to revive the sluggish demand. In fact, that is not a good news for countries which are exporting resources to China, like Brazil and Australia. Of course, staying with the price pressures, as you said, there are certain central bank meetings this week. Canada and New Zealand. New Zealand, after raising rates for 12 consecutive times, they have actually expected to go on a pause this month, while the Bank of Canada is most likely to raise rates by another 0.25% this month, because their uh, inflation is much higher than their target, and also the economy is still quite strong, as evidenced by their latest jobs data as well. And staying with price pressures, we had certain data from US. They were not frontline data, but definitely they are something to chew about. Like the wholesale used vehicle prices decreased by 4.2% in June from May, and it is down about 10.3% on a year-on-year basis. And this is the largest decline since the start of pandemic in April 2020, when the index had plunged by 11.4%. So one should recall that used car prices have been one of the largest contributors to the overall inflation in the US as well. And then we also had another news from US was that the non-revolving credit posted its first negative reading since April 2020, and the net change is the lowest since November 2020. Although Fed will be pleased with this report, credit rose by USD 7.3 billion versus an expectation of 20 billion, and that's quite a drop. And it is the credit conditions tightening that the central bank has been pointing to as a precondition for going on a pause on a steady basis. It is good news. Possibly this is taken also by the markets as a positive news, and that's why you had the Dow rallying by more than 200 points yesterday. Overall, the markets were kind of into positive and negative territory, other than Dow, because the corporate results are going to be out in the coming week, and markets are speculating on. And generally, there is a sense that corporate results are going to be downbeat, and possibly that's the reason why S&P 500 and Nasdaq have not performed. And on the yield side, we had the 2-year yield drop to another notch lower to 4.87%. We just a few days back we had hit 5.12 on the back of big beat in the ADP private jobs report, and now we are down about 26 basis points, and that's led to some sell-off in the dollar yen as well, and also overall dollar has been sold off, barring China yuan again, because of the concerns on the Chinese economy. The Chinese yuan is still trading above 7.23, well above the fixing of the central bank. And on the euro itself, has come to the higher end of its recent range, above 1.10, and it's very rather undigestible that euro should be rallying despite a steady stream of weak data from the from Europe. Only reason you can ascribe to this is the rate hike prospects in Europe, which which is not only going to be in July but also perhaps in September as well. So overall, markets have been kind of positive so far, be it on the bonds or on the stocks. Dollar has been weaker, but definitely they are all waiting for the key data on CPI and PPI this week, and that holds a lot of water for the Fed policy going forward. And on the rupee itself, yes, we have seen some consolidation in the rupee after phenomenal rise, I would say, considering that we were in such a narrow range. We had a rise of more than 1% in the USD INR in just 1 week, and now we are seeing some consolidation. But the sentiment of the traders have been so much impacted that despite the dollar index falling, we have not seen rupee gains as much as other currencies. In fact, there is some observation that yen carry trades might be getting unwound against high yielders like India, Mexico, and also South African rand and Indonesian rupiah as well. So that may be one reason why the rupee is slightly on the defensive side. Yeah, I think it's a slow down drift for the USD INR, and possibly we look at a 40-45 support to be tested in the coming sessions. On the premium side, we did have a bounce in the 1 year forward percentage by about 7 basis points. This is on the back of short-term yields in the US coming down, and the actual premium has come up from about 126 to 133 for 1 year, but that's still at a record low level, and it doesn't really encourage exporters to hedge on a a large scale basis. And yes, on a dip, it will be still advantageous for importers to hedge on the spot dip, the spot plus the spot premium being a very attractive level to hedge. So that's it, and just we are looking forward to the key data during this week. Thank you.
Thank you, JK. And quickly, the key takeaways for me was, of course, China, which is on the verge of consumer deflation. Not exactly there, but at least the latest CPI prints show the case, which is not good for the exporters to China like Australia and Brazil. In the upcoming events, we have New Zealand, which can possibly go on a rate pause, while Bank of Canada can go on a possible hike. In the US, of course, US used car prices have been following on a month-on-month basis, while credit conditions have been tightening, as shown by the recent data. That's, of course, something Fed would want to reel in inflation. We saw a good dip in the US two-year yield after it made a high of 5.12%, now somewhere close to 4.8%. INR has been consolidating post the 1% depreciation, of course, and there is some bounce in the 1 year forward premiums, but still it remains at a low level. Amongst all this, I'm sure many of us want to know what's the outlook on gold. And if you want to hear all about a webinar all about gold, tune in today at 5 p.m. Of course, it's conducted by our very own market expert, Jayaram sir, along with Mr. Yashwant Rao, and Mr. Jaideep Banerjee. So do tune in today. The link is in the description of this video. That's it from us today. Tune in tomorrow for another round of fresh updates. Thank you so much for listening.